What's good, YouTube? It's your boy Will coming back with another video for today, August 26th. And as you guys see from the indices map that I like to reference a lot in my videos, it was one heck of a bloody day. A lot of red out there, specifically all over the market. As I had explained to you guys yesterday, Papa Powell, or Jerome Powell, the Fed chair, is having a meeting tomorrow in Jackson's Hole, Wyoming. Where they're going to be discussing interest and potentially raising rates, or in other words, you hear in the media the word tapering. That's just one of those key words they like to use to essentially scare investors, specifically anyone who's heavily invested in the market or in growth or tech stocks, because the I word is probably the scariest word that'll scare them straight out of stocks. And it's very common anytime you in the media hear the mention of interest rates raising or the word tapering, that normally what will precede that is a very, very red day in the market. Looking specifically at the market, as you guys can see in any pretty much index that you look at, the NASDAQ, the Dow, the Russell, S&P 500, there's a lot of red. There were some green, don't get me wrong, like JP Morgan Chase, Amazon, Moderna, Thermo Fisher, Netflix, right? Like some of the big giants were avoided. Again, those companies don't rarely are affected as much by interest rates, if you will, because they're long-standing companies. Like they know, even if the Fed raised rates 2% tomorrow, Amazon's not going anywhere. JP Morgan isn't going anywhere. Netflix isn't going anywhere. Like you get the picture, right? But for a lot of the other speculative growth or tech plays, the interest word is what scares huge investors the most, and will immediately get them to sell out of their positions. So for some of you that don't know what that means or what that is, I actually acquired this visual for us to take a look at. This is a dollar's worth of purchasing power of the US dollar over the last, look like this goes back to 1910. As you guys see, in 1910, $1 could get you 30 bars of chocolate, 10 rolls of paper in the 1920s, 30s, or late 20s, 10 bottles of beer in 1933, 20 bottles of Coca-Cola in 44, and so forth, right? As you see, as of 2020, it'll get you a couple of McDonald's coffee. All that's right. Like it's pretty normal. You guys spend money so you guys can see. The other big visual that this chart gives you is this steady drop in the dollar all the way down to where we are here, right? But the biggest takeaway I think that a lot of people don't pay attention to is this piece right here. A lot of the news media doesn't talk about this either, but the U.S. supply or money supply grew by 3.8 trillion in 2020 alone. You got to remember all those stimmies that people were getting, all that unemployment that people were getting. That equated to 20% of all dollar ever created. That's a huge chunk of money when you stop and think about how much money was printed just last year. So now that the Fed is looking at rates, looking at the stock market, looking at the all-time highs that a lot of the indices are getting to, right? We can verify this. Pull up SPY, for example. Pull up the one-day chart and just zoom out, right? When in doubt, zoom out, and you just see this steady climb, right? You want to verify this again, look at QQQ, the NASDAQ. Again, this fear that's in the market we've already talked about in previous videos, this steady climb, right? Pretty much anything you look at, DXI, I believe, DXI, DIX, or DXI. I always get that one confused. No, it's not that one. IX, what is it? Here we go. IXIC, excuse me. As you see here, again, steady climb, right? So the Fed is looking at the stock market, seeing these all-time highs, seeing that it hasn't fallen. There's a lot of money out there for people to invest in, as you see in growth and tech stocks. So when the Fed talks about raising interest rates, essentially what that's potentially going to do, or what will happen in a market, is you see this little red tip. Well, last year November, which is, where is last year November? Last year September and November. So here's October, here's September. There was talks of the Fed raising rates potentially at the end of 2020 because there was speculation that the vaccine was going to come out. And just with the speculation, meaning just the thought of it, and you can see these major dips in every single index. So this is one. Let's look at SPY. Look at the same time frame. So that's March. This is October. As you see here, September 1 all the way through September 28th. We corrected a little bit, came back from it, and then boom, came October, and then boom, once again, same thing. Let's look at QQQ. Same thing. Look at matching charts. Every major index, as I've told you, will show you fear in the chart if you know how to identify it. So just the fears of interest rates getting raised last year alone corrected this. Now that there's going to be a meeting where, I guess if you will, the daddy of the stock market is going to come out and speak, and just the potential that he may raise the rates has the market pretty scared today. Again, as we see from the charts, it's pretty clear and indicative what the market is thinking or trending, right? If you want to take a deeper look into what potentially will happen, as my prediction is that they will affirm that they are going to set a date to when it will taper or when they will start raising the rates. And what gives me that inclination is if you go look up the U.S. Treasury yield or the U.S. Treasury bond and look up the 5-day chart. 5 days ago, we were trending at 1.26. And as you see, we have been on this steady climb over the last 5 days leading up to this meeting, where potentially he could even tomorrow say, we're going to raise it 1% and it'll jump. And the only thing you're going to see if that outcome happens is this is going to go from heavy red to solid red, right? It'll be solid red pretty much across every market. You'll see a lot of dips in the charts. Specifically in any index you see, you'll see this heavy dip down just like we did here, right? It'll be something similar. If it gets raised to a very high extreme where it spooks the market completely, you could see a very large dip in prices, which all that's going to do, again, it's not a bad thing. These type of days are not bad days. Again, it is psychological. You just have to program your mind. These are buying opportunities. Everything you're looking at in red on this chart is essentially on sale for you. Again, why would you pay 364 or 384 when you can pay 364 today? Why would you pay 152 when you can pay 147, right? Why pay 305 when you can pay 299, right? Everything is on sale. Red days are buying days. Those are the days you want to buy, and I'll get to that further in the video, but I think you guys get the point. Expect tomorrow that Jerome Powell can come out. He may say that he is going to raise rates, and that is going to spook the market. It will be a heavy red day, but also something to take into account. A lot of the people we are fighting against or competing against, if you will, the hedge funds, they own 80% of the market, right? They own all these major companies. Like, they own big percentages of them, right? So as the Fed were to raise rates and these companies were to take dips, the one who's going to end up losing the most are going to be the hedge funds. Primarily, the hedge funds we are competing against with short positions in, for example, AMC, which today also followed or mirrored the market and did have a red day. Specifically looking at the chart, as you guys see, it's not even my right company. What happened? What did I see? AMC. As you guys see today, from the start, we did have that morning dip that we are accustomed to, followed by a nice little rip. We got past our line of support or line of resistance at this point, since we were below it. Broke up to 44.78 before correcting twice to close out the day flat parallel, right? We ended at 40 or 40.07, or specifically 40.31. We did pop up a little bit right at the end, as you see here. It wasn't nothing major, but again, this is also, you have to take into consideration two things. Number one, the shorts are still continuing to short. We've already confirmed that, as Lucid Tracking has shown us that the short shares have increased. So we know they're increasing their position, so that means they're still shorting. Two, the market had an extremely red day because of interest rate fears or hikes potential. So again, the market dipped. So AMC is part of the market. It's automatically going to have to dip. As I've just explained though, because hedge funds do own such large positions in most of the tech and growth companies out there, because they're the biggest in the industry or in the market, as the interest rates were to be raised, for example, let's just say tomorrow he comes out, says, yep, we're going to raise rates by 1% by the end of the year. Perfect. The market's going to start dipping red, which means that the hedge funds who are holding not only these major short positions, but also the large growth and tech companies, their portfolios are going to dip. Well, you can't do both. You can't be holding 92 million short shares at 40 something dollars a share, or 50 whenever they purchased these, right? We were in the 40s and the 50s when we got to 70. So these are bought pretty high. So that's a lot of money. Plus, on top of that, it's going to get compounded because they're going to be losing money on their tech and growth shares at the same time. Which, if that's the case, one of the two is going to have to give, right? So either they're going to have to start mass selling off companies like Facebook, Microsoft, Tesla, Google, Amazon, Netflix, or they're going to have to get rid of the short positions. In either case, that is a winning strategy in my eyes and something for you to expect. Tomorrow's prediction that I'm already going to go out there and say, just flat out, it's going to be another red day. Specifically, I'm thinking, where's my chart? Looking at this chart here, I'm predicting we will come back down to this $38 mark or $40 mark, and then probably parallel out heading into Monday of next week, and we will see what that brings us next week. Again, as we've already discussed in the options chain, for next week, there are not a lot of significant puts. We do have more calls, as you see today. We even again added more calls over puts, meaning that the opinion of this stock is that it is still going to rip higher. Furthermore, I actually did take some screenshots throughout the day of some pretty interesting things I saw. So this is called level 2. Level 2 shows you the buys and sells in a day. And some of these were pretty substantial. So for example, this 25,000 share purchase at $44 equated to $1.1 million or 1.112 or 1,112,000 shares. And please check me on that math. I'm doing it in my head as fast as I can. So this is a $1.1 million bet. This was pre-market, prior to the market even opening. There was another one. This one. This one was a sell. This one was, again, this is what a short ladder attack essentially looks like. This one here. This one was 3,300 shares, which equated to $143,000. And then we had one last one that I took that I was able to catch in time. This one here. So this one was essentially another $550,000. Again, check me on my math. I'm doing it as fast as I can in my head, but I think you guys get the point. These are some massive orders that are coming through. This is not all retail. This also is institution or big institutions buying in, which I feel will only help us in the long run push the price up higher, as they see what we're seeing, that there is a massive short position on AMC, which indicates to them that it's a short squeeze play, which indicates that it's getting close to the limit of squeezing, right? Another confirmation that you guys can take advantage of or use, it's another tool that I like to use sometimes, is called the Fibonacci retracement. So anytime a stock has a rip, it's going to have to pull back, right? No stock runs straight up forever. No stock runs straight down forever. There has to be healthy pullbacks. So you rip, you pull back, so that the RSI can cool, and then you rip again, right? So when you hit overbought, you cool down, you pull back, and then you followed up another rip until you get to overbought, and so forth and so forth and so forth. That's the cycle of the stock market. That's how all stocks operate. That's how you find winners, or where you can put your money to invest in, right? So if we're looking at this Fibonacci retracement, if we start at the bottom before we got into this rip all the way up to 48, down from 28.57, you see we've essentially corrected down to the 38% mark, right? And as you see, we zoom in, these candles are forming right on that 38% mark. So we've only corrected 38% from our total gain, which is healthy, right? Because then it gives us more room. As you see, the RSI is resting low on the oversold area, which gives us room to rip again. With all these major buys and these large buys coming in, like I told you, 500,000, 1.1 million, 143,000, that's indicative to me that there is more potential for this to run in coming days or weeks, right? So you just got to be patient, right? The major play right now that a lot of people are saying is to not buy options. I've explained options in light of what you can do and how much you can gain potentially on them. But obviously, the more shares we buy, the less they are available to the market, which means this price will only keep climbing higher and higher, right? Options, you're not buying the shares, you're buying the control of them, which is the difference. I also want to highlight that our line of support that we drew here is almost spot on to this Fibonacci retracement. Like, that's super, super close. So again, just another piece of confirmation. But anyways, I think you guys get the point. Please expect that for tomorrow, that potentially we could have another deep red day, especially if the Fed Chair Jerome Powell does say that he is going to confirm tapering or the raising of rates, just so you guys have an expectation. If he were to come out and give a neutral conversation, essentially where it's not really specific what they're going to do until later 2022, what you potentially will see then is for us to parallel or trade sideways, consolidate essentially on this 38% line, and then get ready for Monday for another rip, which I think is very likely to happen as well. It just depends really on what Papa Powell decides to say. The reason I call him Papa Powell is because people don't take into consideration that he, as the Fed chair, can easily say, I'm going to raise rates, and literally control what the stock market will do. Or he could easily say, we're going to leave it at zero for another 2 years, and you're going to see this stock market map go completely green across the board. So that, to me, is pretty much having control of the stock market. When you look at it from that perspective, that's why I refer to him as Papa Powell. If you've ever heard his lectures, please look him up on YouTube. He is a really, really intelligent, reserved man. Another one you might want to look up is the SEC chair, which is Gary Gensler. He actually has lectures posted on YouTube from when he was teaching at MIT. Super bright guy, super bullish on crypto, super defensive of the retail investor. I will tell you those three things because I've watched hours of his lectures. Man is bright, man is honest. So we have a lot of good things in our favor. Don't get down again about a red day. Those are buying opportunities, not bad days. But I'll leave it at that, guys. Please leave a like or a comment down below, as it does help with the YouTube algorithm. Please don't forget to like and subscribe. I appreciate each and every one of you that watch my videos every time and get through the end of them. I'm going to keep trying to get better for you so that I can give you better content and better information for you guys to make better sound decisions in your guys' financial lives. Guys, wish you nothing but the best. I'll catch you guys in the next one.